Yeah, I agree. In fact, our DC people say that it's a 100% chance there'll be a tax act. But because with the failure of repealing the healthcare reform, they've got to score a point. However, the issue is, will it be really a substantive change like in 1986 Tax Reform Act? Or, well, they can't agree, it'll be very superficial, but the administration, et cetera, can still say, well, yeah, we did pass a bill.
Exactly.
So the questions could be what's in the bill.
No, I agree. I would also point out that from a financial statement preparation perspective, the actual signing of that legislation becomes very important. If the legislation is signed before the end of the fiscal year, then your books and records and financial statements have to be prepared in accordance with the existing law. And that can be a nightmare for some companies. So just to make sure that you're aware of the importance of the actual date in which the legislation is signed. Now, if it's everything is done except the signature, that still creates disclosure requirements, and you still want to make sure that's considered in your financial statements. But if the actual legislation is signed and you're subject to U.S. tax, or this has a material implication on your financials, you're going to have to figure that out for your financial statements and make sure you prepare them accordingly.
Is there a particular accounting firm that you can think of?
Yes, actually.
Funny you should ask.
Thank you. Originally where we were, is that doing huge things, as Donald Trump would say, is very hard. It is very difficult to get this through the actual process. The Republicans have, as they've shown with the Affordable Care Act debacle, are not united. Currently, where we sit is that they have 48 yes votes in the Senate, so they're still too shy of the tie, and they do have the tie-breaking vote. So there's 4 people left to work on. There's only 52 Republican senators. They will receive no Democratic support in the process.
Yes, they will.
You think so?
If they get 50 votes, they'll get some Democratic support.
If you
Yeah.
think so?
If they don't need it, they will get some Democratic support.
That doesn't really matter.
Exactly.
But okay. And so they're still working through the issues. The latest out of committee, Bob Coker and I think it was Johnson, they both turned their vote into a yes vote yesterday and passed it out of committee. Currently, what is actually in tax reform is still a little in flux because we've got a House bill that has legislative language that's published that details out a pretty significant change in corporate tax and individual taxation. We've got a House bill that has a conceptual framework. A Senate bill, sorry, that has a conceptual framework, but the actual legislative language is not perfectly intact yet, not published yet. If I go through a couple of the big provisions, and I know there's a lot of detail on the slides, but as I mentioned, these slides are already a little bit outdated. If I go through a couple of the big provisions, the biggest one is the corporate tax rate would be reduced to a flat 20%. That is in both bills, and that is it comes at a cost of about $1.4 trillion. The Budget Reconciliation Act has to reconcile back to $1.5 trillion, so that is the significant cost of the bill. There are a number of other changes for the corporate taxpayers. It goes to a territorial system, which then creates changes to how the dividends received deduction is computed and how foreign earnings will be treated. There's a repatriation or deemed repatriation of tax for previously deferred earnings of foreign subsidiaries. That is currently sitting at 14% on cash or liquid investments and 7% on illiquid investments. And that's similar in both bills at this current time. There is a repeal of AMT. There's a number of small business reforms that change the expensing, 179 depreciation, inventory accounting, UNICAP, other things like that. And then there's cost recovery efforts, which change the deductibility of interest. There's also a 100% expensing of depreciable items that's allowed for the first few years. Changes to how net operating losses are treated. So In other words, from the corporate perspective, it is a very significant change in the way that the income taxation of corporations would be treated. Now, how does that really impact the captive industry? And you kind of have to look at the captive industry in a couple of different buckets. The one that I operate the most in is the property and casualty bucket, where you have qualified insurance arrangements. For a qualified insurance arrangement that meets the 4 pillars of insurance, the differences are material, but they're not as draconian or significant as one might think. The 953D elections are still there, that's not being repealed, so you could still be deemed to be treated as a U.S. taxpayer. What is the difference is that the book-to-tax adjustments, or the tax add-backs, so to speak, within the structure are calibrated more in the government's favor. And basically what that math does is it puts those adjustments back on a 35% rate, even though the property and casualty company as a whole is subject to a 20% rate. So that's the biggest bucket that I operate in. On the life insurance side, it's still very much in flux. There's a long story around that could take up the whole hour if I explained all of the stuff that was going in and out with the life insurance industry. But basically, they're still trying to determine what their book-to-tax adjustments will be in the final bill, and that has to get through reconciliation. And then in the non-qualified space, there's some international provisions that could come into play. The one that gets a lot of traction is the one around the excise tax. Currently, there would be an excise tax on deductible deductible payments, not premiums, deductible amounts remitted to foreign insurers or foreign companies. That excise tax is at 20%, but it only triggers if the amounts paid are in excess of $100 million. And that's in one version of the bill. The other version of the bill is a little different scheme, so we're still waiting to see how that may shake out, but there's a tremendous lobbying effort, as you would expect, to try to mitigate the impact of the excise tax on payments made to foreign affiliates. And I don't know where the odds makers are on this provision, but it does look like there will be something that comes in around either 10 or 20% on those from an excise tax perspective. And I don't know where the floor will be in which you have to cross in order to trigger that excise tax. So that's definitely something to be aware of.
And there's also provisions been proposed to basically allow foreign tax credits and other deductions to reduce that, but how many people here receive more than $100 million from a single party a year? I don't
Right.
know. Not gonna apply too much to you.
Right.
I just wanted to mention but the one thing that I just want to expound on for 1 second, as Paul's taking a second
Ramble,
here, is that the reduction in rate and the discounting factor for all of you is basically going to have a profound effect on people's desire to form captives in the future, because the benefit of the captive obviously is based on those 2 issues. And given the fact that we're going to reduce, and the net benefit at the end of the day for a captive is really the reserve deduction, because the parent corporation takes a deduction for the premium, the captive picks it up, and then it's the reserve deduction, which is basically the benefit to the corporate group. So if we're going to reduce that reserve deduction, it's going to reduce the benefit initially that people are taking of taking the deduction up front rather than paying the losses over a period of time. So.
And if the cash that you collect due to that deferral of income or acceleration of deduction is basically a 20% subsidy versus a 35% subsidy, then obviously the investment yield is lower, and therefore the net present value of holding the captive from a tax efficiency perspective is lower.
So you will see changes in feasibility studies if this thing goes through as to what the delta is on the benefit of forming the captive.
But just a caveat, we're talking here about captives owned by taxable entities. And when you look at the other side of the fence with the captives owned by tax-exempt organizations, a lot of this will have little, if any, effect. So the hospital captives that are in the charitable world probably will sail through with nothing significantly happening.
So, with that, I know that was a lot of information. Some of it is definitely is unclear. If there's ever any questions or any need to just raise your hand and interrupt, that'd be great. We'd love an interactive session. But with that being said, I think it'd probably be best to move on to Avraham. Oh, wait, got a question?
Yeah,
On a personal level, are they gonna do anything on, capital gains?
On a personal level,
I don't
are
think
they
they've-
gonna do?
I don't think they've said that they're doing anything to capital gains. Well, no, I don't
No,
think they've said they're doing anything to capital
I think
gains.
one of the things that's most interesting around the personal level, first of all, we do have two kind of different bills going on right now, one with a lot of different rates and one with 4 different rates. But the most interesting thing is that the personal side did not adopt a territorial system. So from a US perspective, individually, you'd still be taxed on your worldwide income. And then no, I haven't seen anything with regard to a change in the capital gains rates or the dividends rates.
The only thing, there hasn't been discussion of that in connection with this, but with the healthcare reform, wherever you are back there, they did try and discuss, because of the Obama, the 3.7% Obama tax on capital gains, which would be repealed if they had repealed the Obamacare provisions. But they have not talked about doing that in connection with this tax reform bill.
Right.
Right
That's
now.
gone. That's off the table right now.
And I just want to mention two quick things that Paul sort of mentioned, which may have gone. There are 2 provisions, one which is this repatriation provision. So if you have a CFC, if you are a 10% owner, U.S. shareholder, in other words, you have 10% of the voting power of a foreign corporation, whether or not it's a CFC, what they're saying in the bills, is that you're going to have to pick up in income, if the bill passes, and pay tax on over an 8-year period, all of the untaxed earnings and profits attributable to your share going back to 1986. So that, somebody here smiling, most people who might have to pay that are not smiling. And the other provision which is relevant is some of you may be involved with sort of captives here where you're structured very carefully to make sure you're not a CFC by having voting cutbacks and so people don't have enough voting shares. Now what they're going to do then beginning in 2018 is that it's not going to be 10% vote anymore. It's going to be 10% vote or value to determine whether you have 25% of the company. Yes, sir.
Any idea on how to determine value? Is that gonna be liquidation?
I don't know the answer to that question as yet. There will probably be something in the regs because that'll be a trigger point for all of this. But it will make some of the captives, which are more commercial companies, if you will, they will have a lot more difficulty trying to avoid the CFC rules. They'll have to get everybody either to be foreign, truly foreign shareholders, or they're going to have to be, everybody's going to have to be under 10%. So that's also another thing that you might want to keep in mind. Yeah.
Is that related to those rules, whether or not you're a CFC versus an NCFC?
Yes.
Yes.
Yes, because those rules were always triggered by finding people that have 10% of the voting power and then seeing how much value they have. Now, it's going to be voter value, so it doesn't really matter, you can't avoid it that way. Okay.
you know, Paul, you had a comment though on, here, let's go back a couple, to the foreign passive investment, the PFIC, Passive Foreign Investment Company rules. You know, the IRS issues those regs that to be an insurance company, you got to have employees, and everybody was upset, and then they're going to reissue. The bill does address the PFIC situation, yes? And it's formulaic now, you got to have
The-
25%?
Yeah, the
Let me go
formulaic
back.
approach of,
Yeah, it's the second part of this.
yes, I'm not sure, I don't think these slides probably accurately show where the Senate bill is, but whether the balance sheet liabilities of an insurance company equal more than 25% of the total assets. And in determining the balance sheet liabilities, there are only certain liabilities
You
that
don't,
are
you don't
included.
include under
Loss.
premium reserve, you don't include loss adjustment expenses, right?
You
don't
don't
include
include,
them.
you don't include the unearned premium reserve.
And you don't include LAE, so all you got is your insurance liabilities is what's got to be,
No, you do include the LAE.
well, I'm not going to argue with you, but all right. Well,
Okay.
one way or the other. The UEP is out, that we
Yes,
both agree that.
that was the one that was somewhat interesting, because in versions of the bill, it was written to, you could read it as though it were included, and then they clarified that it wasn't included when it came out of the chairman's mark.
Well, let me just ask, but for the rate reduction, is there anything favorable to captives in this tax reform bill, or is it all negative? Sounds all negative, pretty much, right?
For the most part.
Yeah.
Yeah, I don't see anything favorable.
See, the other thing that I don't really, and I don't want to get into this discussion because it'll be the whole rest of this thing.
All right.
But when you talk about these changes to the CFC rules, and the question is, how are those going to apply to cell companies?
Right.
Where you have this quasi-stock interest in cell companies, and the question is whether it's the cell or the company or what. That may be a whole new can of worms if all this stuff passes.
Right. And it'll take years for the IRS to issue some kind of guidance on it.
All right, I
So
just want to say that
we'll
may
be in
another-
major limbo.
That may be another issue that, you know, people may be thinking about afterwards. Anyway, let's just switch to the Abrahami case. The Abrahami case was an 831B case. It was basically, it was in litigation for years, actually, and finally was decided this year. I'm going to go through the facts as quickly as I can, because I don't want to take up the whole thing going through the facts, but Mr. and Mrs. Abrahami owned some jewelry stores and some real estate companies, and Mrs. Abrahami owned Feedback Insurance Company, which was formed in 2007 to insure basically the risks of these companies and some issues, or some risks that the Abrahamis had. It was domiciled in St. Kitts and made a 953D election and an 831B election. And it entered into a quota share, it entered into a quota share reinsurance agreement with a company called Pan American, which basically assumed terrorism risks from a lot of insureds. All of those insureds were associated with the captives that assumed the terrorism risk from Pan American. So Pan American was working more or less like a pool, if you will. It took the risk from the insureds, pooled them, and then each of the captives got a little bit of everybody's risk, okay? The insurance costs of the Abrahamis' business was somewhere between $90,000 and $150,000 a year. And when Feedback came along and they started putting these other coverages in, it went to close to an additional $1.1 million per year. Going to Feedback, the $90,000 to $150,000 was going to commercial insurance companies that basically provided the more normal coverages that they had. The IRS exam started in 2013, which coincidentally was when the first claims were ever filed by the Abrahamis against Feedback, in the aggregate amount of probably less than $10,000. Most of those claims dating back to 2007 and 2008. Let's say this, the opinion was 100 pages long, and I'm not going to drag you through 100 pages of the opinion, so I just want to hit some highlights here. Basically, Feedback insured only 3 or 4 entities. And basically what the court said, well, they only insured 3 or 4 entities, and you are all familiar with the IRS rules about, 12 separate insurers and 5 to 15% of the risk, et cetera. Well, what happened at trial was the IRS put somebody on the stand, an expert, who said you need 35 entities, which is considerably more than what the IRS espoused in its rulings. And then the taxpayer put an expert on the stand who said you needed 7 entities. And then the court found they only had 4 entities, so no matter whose testimony was correct, they didn't have enough. So that went out the window. Then the court looked at, if you remember, in the Rent-A-Center case and the Securitas case, the tax court said, no, we don't look at entities, we look at exposure units. So then they said, well, we got 4 entities with 4 buildings. We have the Abrahamis and 35 employees. We don't have enough exposure units either. So we don't have enough risk distribution there. And then they looked at this pool. And basically, they said, I think the premium for the pool is 80 times what it should have been, 80, based on the commercial charges they had for terrorism. It was all terrorism risk. Furthermore, they said that the policies only covered for risks where there were cities of less than 1.5 million insured, where the insured was located in a city of less than 1.5 million population, and most of them were in cities with a population of more than 1.5 million, so there was really no coverage. And so they said, well, you didn't get any risk distribution for participating in the pool, and although they didn't say it specifically, what the court seemed to imply was the insurance, no insurance really went in, so the insurance didn't come out, so you got no benefit from that either. and therefore they said, this doesn't work, it's not an insurance company. And then they didn't stop, because I think the judge was just, you know,
He was on a roll.
he was on a roll, I guess that's right. And then he started talking about the various policies that were involved. And so some of the policies, one of the policies was, and I'll just mention a couple of them. One of them was a policy that said basically, if you file your tax return and the IRS charges you interest, penalties, or additional taxes, then we will pay. Now, raise your hand if you think any insurance company on this planet would issue a policy like that. Then they had another policy for overhead expense, which would be engendered if somebody opened up across the street and started to compete with you. I asked the same question. Anybody ever see a policy like that? So, and then there was another policy that basically said for litigation expense, and it said it will cover any litigation expense that you incur in your business, either in defending yourself or in suing somebody else. Yes, okay. So some of these policies had kind of strange provisions, and the court raised questions with regard to them. And then there was a loss of key employee provision. There were only 35 employees, and they had to include Mr. and Mrs. Abrahami as key employees, who owned the company, as key employees, which would engender payment for the insurance company, which probably most insurance companies wouldn't do, because if they didn't include them, they couldn't get the premium up high enough so that Mr. Abrahami could take the deduction that he wanted to take. So, as you can see from these facts, there were a lot of sort of bad facts in the case, and the judge went through this, as Tom said, he was on a roll and he was going through all these bad facts. And just as a postscript, what happened, there's two more cases in the tax court. One of them is very similar to Abrahami, and the other one's another 831B case, which is not the same facts. The names of the case are Wilson and Kaler. And right after the case, a couple things happened. First of all, the judge went back to the Wilson and Kaler tax court plaintiffs and basically said, I want you to redo your briefs based on my decision, taking into account my decision in the Abrahami case. And those have not yet been filed. And
Which is why we're different than Avrahamic. So, right.
And in addition, what happened was that the Abrahami plaintiffs went in and filed for reconsideration from the judge. He denied everything that they asked for. And we understand that, I mean, this is rumor, I don't know if it's true. The Abrahamis are planning on appealing the case. We will see what happens there. The last thing I want to mention was there was a penalty, an accuracy penalty of 20% that the IRS sought to impose. The judge said, well, you had advice from at least one lawyer who we didn't think was a promoter. One of the other lawyers they thought was a promoter, and therefore they wouldn't count, if you will. And they said, since it's a case of first impression, and since you had advice from somebody who was a lawyer who we could see that you might want to rely on, we are not going to impose the penalty. Now, I would say that that was very nice of the judge, but it doesn't portend well for cases down the line, if you will, because the court might not be so nice in those cases, and those penalties might well be imposed.
Yeah, now there's precedent that, this doesn't work. So, why are we talking about Avrahami here anyway? First, the IRS lost every case in the last 10 years except this one they won. And, what do we draw from that? And the answer is not that much, because all these cases are based on facts and circumstances. The IRS, I guess I'll give them credit, cleverly chose a case to litigate in which the facts were very favorable to the IRS, unfavorable to the taxpayer.
Cleverly.
But, however,
Cleverly.
Cleverly.
They wrote a 400-page brief in the case.
well, they put a lot of effort into it, a lot of our money, taxpayer money. But the interesting part of this judge is he really played it straight in his 100 pages, and he applied all the general principles that have been evolved for the last 25 years and went down the list. So he didn't change any principles. He just applied them to these facts, right. And they didn't, the taxpayer came up short. And there's a silver lining to this that we'll get to, which is that the judge is still looking at all the common notions of stuff that we've thought about, including that he actually used the word important, that the number of risk exposure units is just as or more important than the number of entities. Now, we didn't have to, that's sort of what we call dicta, because he didn't need it, because there's only 3 entities around Phoenix. So, but he's still saying what really counts are the number of exposure units. So this is gradually changing the basis of how do you define risk distribution, which is a key element of insurance, and usually the one the IRS attacks.
Right, I was actually gonna point that out as well. The other interesting thing, while there was only 3 or 4 entities, the entities were, in some cases, flow-through organizations.
Yeah.
I know there's always been a concern, while certain flow-through organizations are not disregarded entities, you still have to align that with 2005-40 and question whether or not, you know, that flow-through means that the risk flows up to the parent, and then is this a parent-subsidiary
Yeah,
relationship?
just, you know, we're talking about, we're mostly focused on what's single-member LLCs, which the IRS considers to be disregarded, i.e. you ignore them, think of a partnership with one partner. What's that? It's a nothing, okay? However, they have limited liability, and in the rev rule Paul just referenced, they take the position that single-member LLCs do not count for brother-sister risk distribution purposes. Then about a year and a half ago, this Healthmark case comes along, and the taxpayer filed a petition in tax court, and the whole issue in controversy was whether these single-member LLCs count or not. All right, so you got the taxpayer saying essentially they do, and then to make a long story short, the IRS decided that they'd concede the issue, they would not go after the extra tax, and, you know, everybody lived happily thereafter. Now, we don't have any opinion, so there's no precedent.
Right.
But it does kind of say that the IRS is not that excited about going to court
Yes.
on these pass-throughs, because they think they probably are going to lose.
Yeah, so unlike tax reform, where it's kind of hard to find the silver lining, here we
Yeah.
see that there's more deference provided to risk distribution as being the number of exposure units.
That's right.
And then we also see that there was indication that flow-through entities are entities for purposes of the IRS's analysis of
Correct.
distribution.
Right.
But all I'm gonna say is, don't everybody jump up and yell, exposure units are wonderful, because if, it could come back and bite everybody, because quite frankly, the court didn't say how many exposure units are a good thing and are necessarily necessary to give you risk distribution. So, and because in the cases that really talked about it in Securitas and Rent-A-Center, there were a lot of, thousands upon thousands of workers or cars or locations that related to this insurance. And so, you know, in Abrahami, they said it wasn't enough, you had 35. So there's a big spread between 35 and thousands and thousands. And the question is where that line is gonna get drawn in the middle, because if all we're looking at is exposure units and they draw a line, some of the smaller captives may not have enough exposure units.
So we might as well take the bull by the horns here, and for all of you who are at hospitals, big healthcare systems that are tax exempt, to take the position your captive is not an insurance company, which has a lot of benefits like no federal excise tax, no unrelated business taxable income, probably no state self-procurement tax. If you really focus on exposure units, any hospital with thousands of patient encounters every week is going to have plenty of exposure units. So the question is, could the IRS turn these cases against the tax-exempt healthcare world? And there's no indication that they are interested in doing so. They still have 3 revenue rulings outstanding from 2002 that give their very strict standards on what it is to be an insurance company. They chose not to appeal their losses in Rent-A-Center or Securitas. They haven't withdrawn the rev rules. So technically, the agents have to follow the rev rules. So there's no practical, at the moment, exposure or, let's say, vulnerability of the tax-exempt captives. However, having said all that, many of the captives are not capitalized enough, have other reasons not to be insurance companies. But without getting technical, there's some special rules in the Treasury regs that apply just to tax-exempt orgs. And the concept of it, to make it oversimplified, is if you had a whole group of 501c3 tax-exempt hospitals, let's say under common control, i.e. the board of those entities can be chosen by the parent, then that's treated as a single entity. for tax purposes, even though there's no consolidation in tax exempt world, and therefore you could get to the conclusion there's a single policyholder and that can't be insurance. But all this is speculative. Nothing's happened in this direction, but I know the accounting firms are starting to think about it.
Exactly.
Oh, Dale, hello.
Two Aberhami questions. First of all, Bruce, you mentioned that this and subsequent ones are 831B cases, but I look at these facts in here. The fact that they made the 831B, or even the 953D election, doesn't really, what does it matter? I mean, it wasn't insurance.
What, oh, no. To be an 831B company has to be insurance one way, or an 831A company has to be insurance one way or the other. And to make a 953D election, and part of the case went into the fact that the 953D election goes away because you're not an insurance company. And there's some question about whether the judge may have been right or wrong with regard to his decision about when that happens, but put that aside for the moment. 953D basically needs to be an insurance company. So if your question is, what's the difference between 831A and 831B? None, as far as that's concerned.
Yeah, same thing. Yeah, maybe it
Correct.
would help, because we're here in Cayman, you can never ask, like, what don't you know? But is 831B a familiar term, or the micro captives to most people? Or they're small captives that now can have up to 2.2 million annual premium. You get a great tax benefit because they only pay tax on investment income, not on underwriting profit. And so the IRS is after them with a vengeance, and that's created these cases, but as just pointed out, they really have to meet the same standard as any other insurance company, so there's no difference.
Second question, why did they pick 2009, 2010? It looks like this thing began in 2007.
Why did they pick those years?
They're still open.
Because they were, those were years that were open when, as Tom said, when they walked in the door, and maybe 2007 was no longer open, and other statute of limitations had expired with regard to those years. Remember, they came in, the audit started in 2013, so 7 and 8 might have been closed by then.
Okay. So, but would 11 and 12 be,
Yeah, those are possibly still open, and they're probably gonna go make adjustments in those years as well.
okay, thanks.
So the third part of this is, what do we glean from these cases? And actually, Bruce and I wrote most of this part before the Aberhami decision came out. So we're either showing kind of like, it was kind of predictable how it's gonna end and how wise we are that we knew what the judge was gonna do, but here goes. All right, these are like, I guess you call them no-nos, but the coverage does not match genuine needs of the particular industry of the business. So it's a mismatch on sort of generic, and I think a lot of this stems from someone who's selling a program. It's like a template, and they try, so there's promoters of these types of captive insurance companies, and they try to get everybody to fit in the same.
Yeah, I mean, this is not gonna sound very lawyerly or very technical, but I think what the IRS is trying to say with regard to some of these coverages is, you wouldn't have ever bought these things if you were paying the premium to somebody else. And that if you're getting the premium yourself in your insurance company and there are no losses, you're okay with that. But if you were paying this premium to AIG and you'd never see the money again, you'd never buy the coverage because it wouldn't be worthwhile to you. Now, they didn't say that per se, but I think that's really where they're getting to.
Yeah, and see, in Aberhami, remember, their premiums for the commercial coverages were relatively low, and somehow they found $1 million of coverages that they had no interest in previously covering. And you could bet a lot that if there was no tax benefit, they still wouldn't have been covered. So, that, and then the terms, how the policy is written, the scope. There was a big debate about, the judge was kind of perplexed because he couldn't tell if these policies were occurrence or claims made coverage. And he thought they were internally contradictory. And you might say, well, so what's that got to do with it? But the fact is that they weren't up to commercial standards. They were sloppy. And so you got to watch your documentation, because you wouldn't expect the tax court judge to be reading your policies, but it does happen.
Right, I think all these things Tom is going through are not only applicable to 831B companies, but they apply to regular captives as well, so.
Then we have the whole area of what is an insurance risk versus a business risk. So the IRS sort of created out of whole cloth a concept that some risks are really economic and they're not really insurance because there's no fortuity or necessarily an accident. And therefore, you know, you can go ahead and cover it, but you can't get any tax benefits. You couldn't deduct the premium or take loss reserves. And that whole theory remained untested until a couple years ago with a case called RVI, Residual Value Insurance, which is actually a commercial carrier based in Bermuda. All they do is write this kind of insurance. And the type of insurance is they sell insurance at arm's length commercial rates to lessors of business property, you know, think airplanes, computers, even real estate, and that are on a long-term lease. And when you figure out what the fixed lease payments are going to be, you've got to make a guess at what the property value will be when the lease terminates, when it ends, like, so say 72 months from now. So you can go as a lessor to this company and essentially buy co-insurance, pay them a premium, and if it turns out that the property is worth less than was anticipated, they will share the loss with you, okay? In the IRS eyes, this could not be insurance because the IRS says, well, look, the cars, the computers, whatever it is, they were not in an accident. No, it wasn't like anything got damaged. It was the law of supply and demand, and therefore, that's economic, and it can't possibly be insurance. And again, there were like 400-page briefs. I thought, you know, actually, I thought it was a pretty close case, but Bruce's firm came to the rescue, and the taxpayer won. The judge was very favorable to the taxpayer that this is bona fide insurance. It really doesn't matter that at the beginning you know the day on which the insurance will pay off, which is the day the lease ends. There were a lot of factors. This thing was all totally licensed everywhere, didn't have a Connecticut affiliate, NAIC rules. So the judge took all this into consideration, which again shows how important facts and circumstances are, as well as a good lawyer. And so the taxpayer won.
Yeah, the other thing that they said, well, this is a coverage that had been offered by commercial insurance companies for probably more than 50 years. And was even a separate line of insurance in some states. So the court took notice of the fact that this is commercially available.
But the IRS in one of their guidance notes said it doesn't matter, essentially. All right. Well, they lost.
Well,
so.
the guy who put that in their notes retired, so.
Okay, that's good to hear. All right, we're going to go back. So then there's the business versus the, and there were, by the way, a lot of these coverages that we were talking about in Avrahami and similar taxpayers are sort of businessy, you know, like, you know, new competitors or something like that. So keep that in mind. Did I skip one here?
Yep.
Yeah, okay. Premium determined without meaningful actuarial analysis. It is really important to have a believable, understandable, reasonable actuarial backup for stuff. So Avrahami was replete with an actuary who, first of all, didn't do a very good job and did a worse job when he was on the witness stand trying to explain what he did. And that was a disaster. Later, he wrote an article trying to defend himself,
Yes,
but
he did.
it was not particularly convincing. So have a good actuarial study for sure. Premiums exceeding market price. See, that there is this idea that you're just trying to build up the premiums so you get the tax benefit, which certainly nobody does in the commercial world.
I just want to, see, you get into some of these bizarre situations sometimes. So, I mean, I think I, and probably Paul and Tom, and if you disagree, say so. But I mean, I always thought that actuarial determination of loss was probably the best
Yes.
test because basically it wasn't affected by the marketplace. So using market premiums, because the market goes up and down, you can say your premiums are too high or too low depending on where the market was. And that's kind of we had somebody actually doing a New York City or state audit who basically was arguing that we should have used market because
Right.
the market was down at the time and we were using actuarial. It finally went away, luckily. But the point was, it's an artificial way of doing it. So I don't, although the IRS has mentioned that, I don't necessarily think it's right. I think actuarial is
Yeah.
a better test.
We would definitely agree that through RVI, the what is considered insurable risk has been expanded in order to pull that into a sound policy. It has to be actuarially developed.
Right.
And market pricing, at least from our perspective, is is not nearly as critical as actually having that actuarial work.
If you got the history, I mean,
Yes.
that's really all you need. That, you know, that applies to you in the hospital world. When your captive's covering independent physicians, so-called voluntary attending, you don't have to charge those doctors the commercial market rate if you can show a 5-year loss history that's more favorable. Then they earn the discount and they
Yes.
get it. And it's okay.
Now, I will say, excuse me, if you can't get your actuary to give you a number because something like terrorism risk, using market rates as an alternative in those circumstances, having a record of that is probably a good thing to do in the event that you're concerned about an audit.
Right. Okay, so premiums, you know, when they're geared to the deduction, obviously that's bad. You don't allocate the premium appropriately to the various entities based on risk exposure units. You don't have to have, of course you're clear, not every affiliate or brother, sister, sub has to write a check to the captive. You can charge them through your internal cost accounting system, but they got to get charged, and it's got to be an amount that's commensurate or somehow proportional to the risk exposure units. And then sloppiness, you know, sometimes a couple subs forgot to pay, but they never tried to enforce it. Or this problem with Avrahami where there was not a single claim filed until the tax audit, and probably equally bad, then all of a sudden there's a spate of claims, and some of them, according to the briefs, were not really covered by the policy, but they paid them anyway just so it looked good for the IRS. So you can see that there's a lot to be improved with Avrahami. Okay. Captive doesn't comply with state regulatory requirements. You know, it's kind of interesting because this Judge Holmes, he said, you know, probably everything the St. Kitts captive was doing violated Arizona insurance code. But he essentially said, you know, I don't really want to get into that. This is a tax case. Maybe somebody else in another case will. It obviously wasn't a plus because it kind of looks bad, but the judge didn't hold it against him.
But I don't know that, quite frankly, I don't think that's relevant. I mean, they were St. Kitts domiciled company, that was the jurisdiction in which they were regulated. And so long as you were complying with Arizona law for direct placement rules,
But they weren't.
well, then that's what the problem was, not what the insurance company was doing.
And probably equally bad, they did these loan backs that you're supposed to get the St. Kitts insurance commissioner to approve, and they never bothered to even tell them about it.
Right.
Yeah, yeah.
Nor did they have, well, they didn't mention this in the case, but in the government's brief, they said that the board of directors never even approved of feedback, never even approved the loans.
Right. So you want to follow the law, and you want to actually do what's in your filed business plan. And if you deviate materially, you know, you got to amend your business plan and resubmit it, which isn't all that hard to do, especially here. And you can get it stamped in a couple weeks, and then you're still legit. But they didn't do that. A good minute book with the board authorizations and all that covers a lot of ground, but one is it helps avoidance of a U.S. trade or business because you got to show somehow that you really went offshore and did all this stuff because you're telling the IRS, well, we don't do anything in the U.S. And that's kind of a problem if you have all your meetings in Canada because you don't want the Canadian tax authorities to think you're doing all your business in Canada. So the minute book really is when you get audited, what does the agent can ask you to see? First thing he's going to say is, I want to see the feasibility study that was originally done, and you know, let's see if it was just focused on tax or other non-tax business purposes. Then he's going to say, let's see the minute book. So I'm going to go flip through the minutes and try to figure out, did anybody show up at the meeting? Did they talk about investments and claims and all the normal stuff? Or was it just, and if the minutes are the same every year in and year out except the date, you know, then it's pretty clear that it's, you know, these minutes are just kind of a template thing that's not real.
Yeah.
All right?
Well, I just want to mention one thing you skipped, and once it's, before you go, where it says policies and binders issued and premiums collected later than industry standards, or what the policy provides for. This stuff is just very easy to deal with. I mean,
Right.
just do it. I mean, it's all in your control. And quite frankly, one of the things they also complained about was when premiums got paid, et cetera. If you don't want to pay the premium up front,
Right.
provide for quarterly premium payments. And don't pay premiums in arrears, because they will argue that Insurance companies don't generally allow you to do that. You got to pay in advance. But if you want to do it in installments, do it in installments.
So going back to those 4 pillars, this is really critical around that commonly accepted notion of
Right,
insurance, the
right.
4th
Right.
pillar of qualification.
So all I gotta do is say 5, 4, 3, 2, 1. And do it, if you were there this morning. All right. Okay, claims administration, just not up to industry standards. Sometimes claims not filed or reimbursed without a proof of loss. High expectation of no loss. So this guy, Mr. Abrahami, was on the witness stand, and what did he say when the judge asked about if he lost money in the risk pool?
I would be freaked out if I ever had to pay any money with regard to Pan American.
So the freaked out thing, if I lose any money, was it was an admission against interest. Why he said it, I don't know, because nobody prepped him not to, but that didn't help.
Well, honestly, I think that brings up a very interesting question that I have yet to find the answer to, is why did the Abrahamis bring this to court? Was it simply to get out of the penalties, or to establish?
My
What?
guess is their advisors who helped create it believed that they could win.
Okay.
That sounds far-fetched,
Yeah.
but that's my belief.
I mean, I really think, I don't know the answer to that question, because I think it is pretty far-fetched. I mean, they went on in discovery, they were having wars in
Yeah, I know,
discovery
I know.
in this case, because the judge said, I want all documents to be produced in whatever form they're in, so if there was handwritten notes or comments on, and then the stuff got produced and stuff was whited out all over the documents, and they had wars in front of the judge about this, and it was going on for a long time. So the cost of this litigation was, considerably more than it might have been had everybody just gone along and done what they were supposed to do. So it was a pretty expensive case.
Right.
And I really can't believe that anybody thought they were gonna win this case. It just was-
Yes, Dale.
They use that litigation coverage that they bought?
Well, it's funny you ask, because Feedback didn't have any money.
Yeah,
Because they loaned all the money to a
Belly button.
a real estate
a
outfit.
real estate operation, and it was all sunk in a couple of buildings that was owned by their kids, except the kids didn't know that they owned it. That was also testimony in the case.
Which quickly ties into the investments. So if the captive investments are mortgages on real estate that the family owns and all that stuff, not liquid, there's a lot of bad stuff there. And I think we got one more, the risk pools. Risk pools can work. So IRS has recognized a number of risk pools. It's just if you do it, you got to do it right. You really do have to share risk. You can't be freaked out if you lose some money in it. If you're losing money, your tax lawyer will be smiling because he's saying, wow, that means there really is risk transfer. So you got to just swallow it and lose the money. Somebody else is going to make money. And so watch how you do risk pools. So I think we have a couple minutes left here. When are we supposed to end this?
I'm not
Anybody know?
sure. Yes, sir.
I don't know if you can answer this, Paul, or any of the others. I have a client who established an 831B company. She checked all the boxes, all the pillars, premiums are perfectly, I think you would all agree, are correctly done.
Right.
His auditor, Grant Thornton, just said to him, if you take those deductions, you won't sign off on your one.
Yeah, I honestly probably could not address that position. I do know that there are a lot of concerns with whether or not accounting firms can sign off on reportable transactions. Under Notice 2016-66, there are certain 831B companies and structures that give rise to reportability as a transaction of interest. And that mere fact alone may prohibit some practitioners from signing off. That doesn't necessarily mean that the structure is bad, it just means it meets the facts of the notice and it has to disclose, and they may have some prohibition from
And-
acting on it. Now, from our perspective, we will, not that I'm trying to get 831B work, but we will look at 831Bs, and if we believe that they have their documentation and that they're sound, we have no issues signing off on them, but we will do our due diligence on them. It is a sensitive area.
Up here in front, please.
Do you have a captive that writes all third-party business on standard industry forms? Is that a pretty
Yeah, can you hear it says a captive that writes all third-party business on standard forms, or I guess arm's length premiums, et cetera.
Yeah,
So that should sail right
I
through, you
thi-
know.
I think the answer is probably yes. It
yes.
shouldn't be
I
an
mean, that's
issue.
common in extended warranty, vehicle service contracts, whatnot, that some dealership-owned businesses
Yeah.
may have complete third-party. You gotta be careful, because those things have been around for a long time. So in some of those structures, they have expanded their business case and started to cover first-party business. And so that could pull them into disclosure responsibilities or whatnot. But
But-
if it's still the general third party, yeah, that should.
Remember, you don't have to be licensed as an insurance company anywhere necessarily to be an insurance company for taxes. So these, you know, service provider, vehicle warranty obligor companies are treated as insurance companies, but they're not licensed anywhere.
But I'd say the answer to you is probably it's not gonna be a problem at all. But again, some of the stuff that Tom was talking about making sure people pay premiums on a timely basis and claims are done, which probably is happening because it's third party, is something you should always pay attention to.
Yeah.
Yeah.
Just to be clear, in the case you're talking about, this is the auditor for the captive who's refusing to sign off, or the auditor for the owner of the captive?
Both. Same one.
Oh.
Yeah, we've
So,
seen,
Okay, so then I have to ask this, which audit is not being signed?
Companies.
Okay, the parent company's audit is not
Yeah.
being signed, it's not the captive audit.
Right.
and Tom and I have seen this without regard to your, for a lot of smaller accounting firms that had this situation. Remember, we had that group of people that we were talking to, where it was like a family-owned, large family-owned business, and the accountants were very uncomfortable with 830. I'm not saying your structure maybe is fine, but theirs wasn't so fine. And absent the issues that Paul just raised, they were having the same kind of problem.
Yeah.
It's a major corporation, not
Okay,
Yeah.
all right.
All right, we got to wrap it up here. Any last question? All right, thank you.
Thank you.